Welcome to my review for Chapter 4 of the LLQP course. This is for Module 1, which is about life insurance. Now, Chapter 4 is all about universal life insurance, and there are quite a few topics that we will be going over, and it probably will be a bit of a longer video. Now, to start, we're going to look at just the basics about universal life insurance. So UL policies were created after numerous modifications to whole life insurance. So they are quite similar to whole life policies, however, they do have some special features to them. Generally, UL policies offer a fixed death benefit and guaranteed minimum cash surrender value in exchange for fixed premiums. Policyholders have more control and flexibility over the cash surrender value and the amount deposited as a premium. So basically, universal life policies combine permanent insurance with tax-advantaged investing. Now, with UL policies, there is a premium tax, and this is something that is actually on every policy, and it's something that you should be aware of because it might actually make it so investing in regular investment accounts sometimes might be better than investing in a UL policy. For this reason, there are some extra fees on insurance, which will make it harder for the investment account in the insurance policy to do as well as an investment account outside insurance policies. So whenever the policyholder pays a premium into the UL policy, the insurance company passes a percentage of that premium on to the provincial or territorial government in the form of a premium tax. Depending on the jurisdiction, the tax ranges from 2 to 4%, and it is charged on the entire premium, not just the portion that covers the cost of insurance. So this is quite important for UL policies because a lot of UL policies will actually have the premiums go above and beyond the cost of insurance, and you'll want to have an excess amount there to go to the investment account. Now, transparency through unbundling. So there are 3 pricing factors, and it is a lot more transparent than whole life policies. So you can actually see the pricing factors in the UL policy, which is nice. Now, the 3 pricing factors are mortality costs, administrative expenses, and investment income. So for mortality costs, it reflects the insurance company's cost of paying out the death benefit. For a UL policy, the insurance company deducts these costs from the policy's investment account. Administrative expenses, this includes the cost of selling, underwriting, and issuing policies, income tax, the cost of investigating and paying claims, etc. And investment income, so the policyholder of a UL policy has flexibility in how investments are made within the policy, and this is the opposite for whole life policies, so that's one key difference between UL and whole life. Since mortality costs and administrative expenses are more transparent, the policyholder gets a clearer picture of how the investments held within the policy are performing. So UL policies have some flexibility for a few different things. So timing and amount of premiums, so the policyholder can decide how much to pay in premiums and when to pay them. The minimum premiums should be enough to keep the policy in force until age 100, but any excess premiums will help build up the investment account within the policy, which is probably what you are trying to do if you are purchasing a UL policy. The face amount, so when acquiring the UL policy, a face amount or death benefit must be chosen. Additional coverage can be added in the future, however, the insured person will be required to provide evidence of insurability if they do want to add additional coverage. Policyholders can also decrease the amount of coverage. Usually this is restricted to a minimum amount, but the nice thing about the face amount or the death benefit is that the investment account actually gets added to that once the life insured does pass away. So you do actually have some flexibility that way, which would be a way to avoid actually adding additional coverage and providing evidence of insurability and paying for that coverage. Also, there's flexibility for the life or lives insured. So one UL policy can be used to insure multiple lives, either on a joint life basis or single life basis. UL policies may even allow the policy holder to add or substitute a new life insured. Of course, you will need evidence of insurability for this. Now, there are some pricing components for insurance and UL policies. And this is one really important formula to remember for the LLQP exam. So it's the net amount at risk. So the net amount at risk equals the death benefit subtract the investment account value. Now, the net amount at risk is the amount the insurance company is at risk for, and this risk exists until a policy is paid up. Now, there are two ways of applying the risk of death to the net amount at risk: a yearly renewable term and level cost insurance. So the yearly renewable term is a 1-year term insurance that renews at the end of every policy year. The annual YRT premium for a specific year is based on the life insured's risk of death for that year. And then the level cost of insurance is based on the concept of buying a term 100 policy without a cash surrender value and non-forfeiture benefits. Also, for the level cost of insurance, premiums are level over the duration of the policy. So here you can see how the cost of insurance under yearly renewable term costing is much lower than the cost of insurance for the level cost of insurance in the early years. But in the later years, the level cost insurance becomes much cheaper, and this is because the time value of money. In the early years, the mortality costs are quite low, which means that a good portion of the premium is going to the investment account, and it grows over time. With UL policies, you also have various death benefit options. You can choose a level death benefit, which basically means the death benefit will remain constant at the original face amount, regardless of when the life insured dies, or it will equal to the policy's account value once it exceeds the original face amount. Another option is the level death benefit plus the account value. So with this option, the net amount at risk remains level over time, while the death benefit increases. Mortality deductions will be greater than those for a comparable UL policy with a level death benefit because the net amount at risk remains level over time. The beneficiary will receive the original face value of insurance plus the account value. So this option may be suitable for those who deposit large premiums in excess of the amount required to minimally fund the policy. Another option is the level death benefit plus cumulative premiums. Now, this tends to be the most expensive option, and the beneficiary receives the original face amount plus the gross amount of each premium paid. Essentially, this provides a full refund of premiums when the life insured dies, and if the account value exceeds the sum of the original face amount and cumulative premiums, any excess amount would then be retained by the insurance company. The last death benefit option for UL policies is the indexed death benefit. This provides a death benefit equal to the original face amount indexed for inflation. So some policies index the death benefit by CPI, others allow policyholders to choose a rate between 1 and 8%. The net amount at risk is not level for this type of death benefit option, and depending on the growth rate of the investment account and the index rate, the net amount at risk could increase over time. This type of policy might be appropriate to cover an end-of-life risk that is expected to increase over time, such as the tax liability. Now, for UL policies, there is an investment component to it. So you have net premiums, which is the premium less the premium tax and the mortality and expense deduction. And this is the amount invested within the policy's investment account. So you can think of it as the excess premium. So the amount that just isn't used to pay for the cost of insurance. Investment income earned within the policy tax-exempt investment account is not taxable when it is earned. So it's a lot like an RSP in this case. And if the death benefit includes the account value, the growth may never be subject to tax. The policyholder can have their investment account invested in a wide range of fixed income and equity choices, and they can also choose a guaranteed investment. So basically, they do have a lot of flexibility for what their policy is being invested in. Variability of investment returns and mortality deductions may affect the long-term viability of the UL policies. So for example, back in 2008 with the mortgage crisis, basically the interest rates dropped hard very fast. And what this did is a lot of UL policies actually became underfunded. And this was because a lot of these policies were estimated at a high rate. But because the interest rates dropped so fast, a lot of these policies didn't have the investment returns that they were expecting, and the long-term viability for these policies were not great. So the investment account or the accumulating fund of a UL policy basically plays the same role as the accumulating fund in the whole life policy, in that it can provide the policyholder with a number of non-forfeiture benefits, including surrendering the policy and getting the cash surrender value, policy withdrawals, premium offsets, policy loans, collateral for third-party loans, leveraging, and distribution upon death. Now, if you decide to surrender your UL policy, basically the cash surrender value is the amount that is equal to the investment account, subtract the surrender charge. So in the early years, the cash surrender value might actually be zero because the investment account didn't have enough time to grow and surpass the surrender charge. Policy withdrawals, or the partial surrender option. So with a UL policy, the policyholder can withdraw funds from the policy. There's typically a minimum withdrawal amount, and the maximum amount is basically just the policy's cash surrender value. So surrender charges may apply for policy withdrawals as well, even if you are only withdrawing a partial amount. And the funds are withdrawn from the policy's investment account, which will impede the growth of the investment account for the future and may affect the long-term viability of the policy. You can also do premium offsets. So premiums are naturally offset by the investment income and the policyholder's deposits to the investment account. Depending on the policy, it could even eventually become paid up, meaning the policy could pay for itself indefinitely. The UL policyholder can usually also obtain a loan from the insurance company against the cash surrender value, and a lot like the whole life policies, the loans are typically limited to a percentage of the cash value, which is usually ranging from 50% to 90%. The policyholder is not required to pay back the loan, but the loan balance plus any accumulated interest will reduce the death benefit payable under the policy. One advantage of taking a policy loan is that the money inside the policy will continue to earn tax-sheltered income. The only downside is that the interest rate charged on the policy loan may be higher than the return on the investments in the policy. Also, taking a policy loan may also incur some taxable income. Another option is collateral for a third-party loan, and this allows the UL policyholder to access the capital within the policy without a taxable disposition. So the cash surrender value of the policy can be used as a collateral for a loan from a third party. Principal and interest repayments may or may not be required depending on the financial institution and the arrangement, but the nice thing about this option is that since it is income from a loan, it's not actually taxable, which can be really helpful. Now, usually with collateral third-party loans, when the life insured does pass away, part of that death benefit does have to go to the third party to pay back that loan outstanding. And the last option is leveraging, and leveraging is a variation of a third-party loan. So the UL policyholder may be able to get a loan where the cash surrender value and death benefit are used as collateral. And in this case, the accrued debt, which is the principal plus accrued interest, is discharged only upon the death of the life insured. These loans are not taxable, and they can be dangerous if investment returns are lower than expected. If the value of the loan plus the accrued interest exceeds the cash surrender value of the policy, the bank may decide to demand repayment of the loan. So if the policyholder does not have any other funds to satisfy this debt, they could be forced to surrender the policy to pay off the loan, leaving them uninsured and with a potential tax liability as well. Now, looking at the distribution upon death for UL policies, you have the level death benefit. So usually only the face amount is paid out, although some policies will pay out the value of the investment account that exceeds the policy's face amount. For the level death benefit plus account value option, the policy will pay out the original face amount plus the full value of the investment account. For level death benefit plus cumulative premiums, the policy will pay out the original face amount plus the sum of all premiums, regardless of the value of the investment account. And any excess that may remain, so the growth on the investments, usually is retained by the insurance company. And with the indexed death benefit option, the policy will pay out the original face amount, indexed accordingly to the rate specified in the policy, regardless of the investment account. Any excess is retained by the insurance company. Now, there are various pros and cons with UL policies. One is that it does offer considerable flexibility to the policyholder. They can increase, decrease, or even suspend premiums as long as the policy's account value can support the mortality and expense deductions. The policyholder also does have the choice of investment products and offers the opportunity for tax-sheltered investing within limits. The disadvantage is that the product is quite complex and may be difficult for the policyholder to understand. The policyholder needs to actively monitor the performance of the investment account and make sure that adjustments to the policy investments is changed when it is necessary. Another disadvantage is the entire premium is subject to premium tax. So for this reason, it may actually be better to do an investment in a regular investment account or a tax-free savings account if you do have the room. And policy performance is sensitive to changes in investment performance. Now, comparing UL policies versus whole life policies, basically there is a little bit of difference to them. For the mortality deductions and expenses for the UL policies, you have the two different options, the YRT or LCOI costing, and mortality deductions and expenses are deducted from the investment account. Whereas the whole life insurance, the mortality deductions and expenses are taken from the policy reserves. For premiums for a UL policy, a missed premium does not trigger a premium loan. Mortality deductions and expenses continue to be drawn from the investment account, and the policy may lapse once the account value becomes insufficient to cover these deductions. Whereas with whole life, premiums are typically level for the life of the policy, and a missed premium may trigger an automatic premium loan. For the dividends, UL policies do not provide dividends, whereas whole life can possibly provide dividends. The death benefit for UL policies, you do have various different options that you can choose from, whereas with whole life, the death benefit is generally not affected by the value of the investment account. The modal factors are generally not used in UL policies, where they do apply to whole life insurance. And for the investment account for each policy, for UL policies, the policyholder can choose how the investment account is invested, whereas the whole life insurance policies, the company, so the actual insurance company, chooses how the policy reserves are invested. So UL policies basically have a lot more flexibility to them, and there are a few differences between UL policies and whole life policies. And so anyway, that is everything for Chapter 4 of the Module 1, which is all about life insurance for the LLQP course. And I really hope you found this video helpful. Chapter 4 was a pretty big chapter, but it is one that is really important for the LLQP exam. Anyway, stay tuned for Chapter 5.